So if we ever took silver to a real value where it was in 2011 when it was at $50 briefly, or 1980, and factored in the degradation in the money, silver would probably be $200 just to match its real value then. Okay. So I don't think there's any resistance right now between here and 50, and I don't think 50 is resistance. It's a phantom set of highs that are so old and so long ago that if anybody wants to try to sell against the $50 highs, I bet it doesn't work. And if it works for 2 days, it won't work any longer than that. I think we're going to blow that stuff out.
Michael Oliver, founder of Momentum Structural Analysis, is a seasoned market analyst recognized for accurately forecasting significant financial shifts using momentum-based techniques. In early June, Oliver's momentum analysis signaled an impending breakout in silver, which was confirmed last week as the price breached a long-standing resistance line. Despite minor pullbacks, the breakout remains intact, marking the start of a stronger upward phase, one he expects will outperform gold in percentage terms. Although silver hit resistance at $39 an ounce, it still has plenty of momentum to challenge its 2011 all-time highs, according to one market analyst. After reaching a nearly 14-year high overnight, silver is experiencing intense selling pressure. Spot silver last traded at $38.27 an ounce, down 0.14% on the day. Citing data from Bank of America, Oliver notes that gold and related assets represent less than 1% of the average U.S. investor's portfolio. He says, especially considering precious metals have outperformed the broader stock market in recent years. Historically, a precious metals allocation has improved the efficiency of a diversified stock bond portfolio. Gold, silver, platinum, and palladium have all gained prominence over time as viable alternatives in strategic asset allocation. Investor interest continues to grow. Silver-backed exchange-traded products reached $40 billion for the first time, already surpassing the total for 2024, according to the Silver Institute. Before we dive in, make sure to like, share, and subscribe to our channel. Don't forget to hit the bell icon so you never miss an update.
I think we're in an acceleration phase now in silver. In other words, the bull trend has been going on since the lows in 2015 for gold, gold miners, and silver. Silver and the miners have been somewhat irregular participants in that ongoing monetary metal bull trend. But I'm going to suggest to your viewers that they punch up a chart on their quote screen. Just not momentum, what we look at, which usually tells us ahead of time. So look at a simple, stupid weekly price chart and go back 10 years, and draw a line across, go back to 2022 anyway. Remember 2022, that's when silver had a plunge and gold had a plunge. Gold dropped from over 2,000 and dropped down to the low 1600s. It's a 20% correction, actually, for the only one it had in the whole bull trend. And silver had a nasty pullback. It got down into the $17 level, I think. Plot that weekly price chart. And when you punch it up, draw a line across the highs of the last several years, so 2022, 23, 24, and into this year. And you'll find you can connect a whole bunch of peak weekly price closes. And there's an uptrending line across those highs, meaning it defines the ascent of silver. And it's hit that line 1, 2, 3, 4, 5 times over the last several years, where it hits that line of ascent and bumps its head, and then you get a pullback. Nevertheless, it continues up. That line of ascent pretty much defines what's going on in silver. It's going up every year. Okay. Yeah, there are pullbacks, there's pauses, et cetera, et cetera. Well, our momentum work in early June, so 5 weeks ago, let's say, told us we're going to accelerate now. In other words, we're not going to follow some prior line of ascent that everybody's used to. Price just joined in last week. And if you plot that line, you'll see that last week's action punched through it. In other words, if that line was a ceiling, an ascending ceiling of resistance, even price now says, I'm out of here. Okay. You blew through it definitively. And, and pullback this week isn't even threatening that. In other words, we've accelerated the market. And I think what's about to happen over the next 5 or so months is likely to be the kind of strength that people aren't used to. And therefore, they'll probably doubt it, all the way up. Like, oh, this can't be, I think we're headed into a period of ascent for silver that is far more demonstrable, far stronger than gold on a percent gain basis. Same is true with the gold and the silver miners. They have now, when we measure their spread relation to gold, or we measure silver's spread relation to gold, we're getting breakouts saying, hey, we were sleepy for a while. Now we're going to beat you, Mama Gold. And I think you should put your seatbelt on because I think the next 5 months or so will be quite interesting. And those old highs, when you, of course, value silver at that time, let's say 1980 at $50 or 2011, 14 years ago. What's happened to the dollar since then? I don't mean the dollar index, but the real buying power of the money unit. It's continued to collapse. So if we ever took silver to a real value where it was in 2011, when it was at $50 briefly, or 1980, and factored in the degradation in the money unit, silver would probably be $200 just to match its real value then. Okay, so I don't think there's any resistance right now between here and 50, and I don't think 50 is resistance. It's a phantom set of highs that are so old and so long ago that if anybody wants to try to sell against the $50 highs, I bet it doesn't work. And if it works for 2 days, it won't work any longer than that. I think we're going to blow that stuff out.
Over the past 50 years, gold has experienced two significant eightfold increases, from the 1976 low to the 1980 high, and from the 2000 to 2001 base at $260 to the 2011 peak near $1,920. If a similar ratio scale move unfolds again, it could take gold to $8,000 or $9,000, simply repeating what has already happened twice. Supporting this outlook, Juror Keener, Managing Director and CIO at Swiss Asia Capital, forecasts gold could rise to between $5,000 and $8,000 per ounce in the coming years. He points to sustained momentum fueled by global financial instability and strong demand from central banks. Gold has already climbed 30% from recent lows, showing resilience amid uncertainty, and Keener sees it as a long-term hedge against inflation, currency fluctuations, and geopolitical risk. Meanwhile, during this quiet consolidation phase, gold, silver, and mining stocks have rallied sharply. The spread between silver and gold has strengthened, not because gold declined, but because silver and miners surged while gold held steady. This divergence is viewed as a bullish signal. Additionally, the gold-silver ratio, which historically drops toward 30-1 in a precious metals bull market, currently stands around 90-1. This elevated ratio suggests that silver, which tends to outperform gold during uptrends, is now beautiful. As momentum builds and investor interest grows, both gold and especially silver appear well-positioned for continued upside in the current cycle. Let's go back to the interview.
I don't know where gold's going on this move, frankly. I've said over and over again, and this is not a target. I'm just simply citing a fact. But the ratio scale bull trends of the past 50 years, like up to 1980 peak from the 76 low, was an eightfold move. From the 2001 basing process at $260 gold, the next move up to 1920 was an eightfold move. Well, if we have another eightfold move, just another, did it again, okay, ratio move, would be $8,000, $9,000 gold. That's just doing what we've done twice before. So it's hardly some, unrealistic expectation. But there are different factors at play now. I can see them technically, and I know fundamentally they're there. And those factors are the kind of factors that this time around, the boom bust cycle doesn't just end with the bust and then they print the money and we go back up and have another boom again. This time it's different. The consequences will be far greater and the upturn will be more laborious from very painful levels on those assets that are about to bust. And there will be a realization on the part of academicians, intellectuals, economists, lag to reality, but they will recognize that, hey, you know what? This central bank game we've had for 100 years now, it's just created boom bust cycles. They boom the money supply, cut rates arbitrarily, and we get a nice boom next year or 2, 3, 5 after. Prices of the stock market goes up, and then it busts. And they try to rescue it by cutting rates all the way down, but it never works. And, this game has been going on for 100 years. One long human lifetime, the central bank has been around, our central bank. And if it isn't working, then that realization comes into play where, hey, this time it didn't work. It's not working. We need something else. And that's when the public, especially when you hit them with pain, Like their only thing they've got to smile about, I've mentioned this before, is oh, their 401k. Trump pounded the table the other day. Your 401k is all-time new high, et cetera, et cetera. Well, if it isn't, and that gets taken away quickly, like suddenly it's down 30, 40%, and you look around and all of a sudden layoffs are occurring, and mortgage rates are killing you, and I've maxed out my credit card. You get the point. All these things coalesce to where you have nothing but pain. There's no smiling place to look at. That's when hands go up in the air and people say, we got to do something different. They don't quite know what to do. They just know it's panic. And that's when institutions and realities we think were permanent aren't going to be permanent. And I think one of the things we're going to go back to is what used to be reality, and that is money that's backed by gold. And it wouldn't surprise me that the Chinese are the first to do it. What a world we live in. Who would think? But I think that's coming. And I don't know at what price level gold might ultimately be in silver when that occurs. Well, it's been virtuous because what it's allowed to happen is while gold has gone sideways since April. So we're now 4 months of this, going nowhere. It's not a top. Gold never tops going sideways. Go back and look at the 2011 peak. Go look at the 2015 low. It doesn't top going to sleep. When you see gold go into a range, it's a launch pad for another move. But during the last 4 months, since gold peaked in April, May, June, July, it hasn't gone down, it's gone this way. Every time the bears think, oh boy, it's on its way, goes right back up again. That's a launch pad. But during that time, what's happened? Silver and the miners have gone vertical, meaning the spread relationship between the silver and gold and the miners in gold has firmed sharply. Why? Not because gold's gone down and they've gone down less, but they've actually gone up while gold held its own. So the spread is firmed, favoring miners and silver. And I think it's lovely what's been happening, because the quietness in gold again has put people to sleep thinking, well, there's nothing going on here. Yeah, it is. Take a look at a SIL chart, silver miners. Go back 5, 6, 7 years. Look at a GDX chart. Go back that same amount, just price chart even. Price is now saying what momentum has already told us is going to happen. We're going back. I think GDX and SIL, for example, those two mining ETFs, the 2011 highs will be blown out with ease in the next 5 months and exceeded dramatically. And I think it's underway.
Silver and gold are showing strong signs of entering a new bullish phase. Silver has broken through key resistance levels and is gaining momentum faster than gold. While gold has remained stable over the past few months, this sideways movement is forming a solid foundation for its next upward move. At the same time, silver and mining stocks have surged, suggesting a shift in market leadership. This strength in silver relative to gold highlights growing investor interest and confidence in the metal's upside potential. As silver continues to gain traction, it is well positioned to outperform gold in the near term. From a broader perspective, long-term patterns and economic pressures point toward higher valuations for both silver and gold. With the declining purchasing power of fiat currencies and continued skepticism about central bank policies, precious metals are becoming increasingly attractive. Investor allocation to gold and silver remains low, which leaves significant room for growth. Combined with technical indicators and changing market sentiment, both metals are poised for a sustained upward move. What do you think about the future of silver and gold in this market cycle? Share your thoughts in the comments below. If you found this video helpful, then share it with your friends and don't forget to like and comment. Be a part of our community by subscribing to our channel and hitting the bell icon. Thank you for tuning in.